Another market that was affected was the U.S. dollar. The dollar index got whacked about 80 basis points. We're now back below 99, 98, 85. And the weakness of the dollar helped push oil prices up over 2%, back above $86 a barrel and rising. So now you have a break between oil and bond yields because they had been trading together. Bond yields up, bond yields down, oil down. But today, the bond market shrugged off the rise in oil prices because of the Treasury announcement, but it's not going to shrug it off for long. In fact, because the Treasury, it is weakening, and the weakness of the dollar is going to be pushing up bond yields and inflation, right? As oil prices and other commodity prices are rising, that's going to further complicate the Fed's job because now the Fed is going to have to not hike in an environment where there's even more upward pressure on consumer prices. That is a direct result of the weakness of the dollar. And obviously, Treasury had to know that this announcement was going to weaken the dollar and complicate the Fed's problem when it comes to inflation, because a stronger dollar helps restrain consumer prices. It helps keep a lid on import prices. But when you have a policy that is weakening the dollar, that is putting more upward pressure on oil and commodity prices, make it even more difficult for the Fed not to hike rates. But of course, it's not going to hike rates, especially with Treasury doing this Operation Twist, which obviously is going to expand because the markets now know this. Bond prices are going to keep falling. This is just a temporary bounce. The markets are going to test the Treasury's resolve and ultimately the Fed's resolve. And again, a lot of this too is because of what's happening in Japan, right? The weakness in the dollar now is taking some of the pressure off the Japanese yen and therefore some of the pressure off Japan to sell U.S. Treasuries. But, if you think about this, why the hell would the Treasury be doing this in an environment where long-term yields are rising? The last thing you'd want to do is pay off long-term debt and borrow more short-term debt. And, 20 years ago when rates were this high, and I hear some people saying, hey, it's no big deal that rates are up here because rates were here 20 years ago and everything was fine. Well, first of all, everything wasn't fine, but you can't compare the environment today to the environment 20 years ago when the national debt was less than a quarter of its present size. So you're talking about 5% of a huge number, not a small number. But it's not just that, it's the trajectory of rates. 20 years ago, we were still in a major bond bull market and yields were in a long-term decline. Now it's the opposite. Yields are rising. This is a bear market in bonds, and we're only about 5 or 6 years into it. So rates are going to keep rising. They're not going to fall like they're going to rise, and they're going to be a lot higher. Now, it wasn't just gold and silver that rallied in response to the Treasury's announcement. Bitcoin also went along for the ride. In fact, it got off to a slower start, and it was trailing gold and silver. But then it just took off.
For months, oil prices and bond yields had been moving almost in lockstep, rising and falling together, largely reflecting shared inflation expectations. That relationship broke this week. Even as oil climbed on dollar weakness, the bond market initially shrugged it off, buoyed by news of the Treasury's buyback program. Analysts cautioned the divergence might not last. A weaker dollar tends to push up import and commodity prices, which in turn puts upward pressure on bond yields regardless of what the Treasury is doing. With the 10-year yield sitting near 4.7% and the 30-year touching its highest level since 2007, the underlying pressure hasn't disappeared. It's just been temporarily papered over.
Bitcoin actually got above 70,000. We had been trading at around 62, 63,000. I think it was 63,000 when I did my last podcast. And as I'm recording this one, we're around 69,500. I know a lot of the Bitcoiners are getting really excited. Again, the announcement caught some people off guard. Obviously, I think maybe there were some shorts that covered. Some people got excited. They ran into Bitcoin because this is it, right? This is the big move on inflation. This is a precursor to quantitative easing. Everyone's going to get out of the dollar. They're going to buy gold and silver. They're going to buy Bitcoin. They're going to buy gold and silver, but they're not going to buy Bitcoin. I mean, people are hoping that they buy Bitcoin, and I think this trade is built on hope. So I think the big difference between the rally in gold and silver and the rally we had in Bitcoin today is that the gold and silver rally is the real deal. Not only are gold and silver going to retain their gains, but they're going to add to them. Whereas I expect Bitcoin to reverse and go back down. And I think tech stocks, which showed a lot of weakness today in that they didn't get a rally off of this news. So if we're going to get a bigger correction in tech, then Bitcoin is going to follow tech lower. It's not going to follow gold and silver higher. But what's more important is gold and silver are leading. Gold moved a lot more. Silver moved a lot more before Bitcoin. Bitcoin didn't lead the charge. It followed behind. And so people would have thought, oh, it's even more sensitive than gold and silver. It's not. It was less sensitive than gold and silver. Now, we also got some more economic news that came out today. Again, that is bearish on the economy. The housing numbers, look at housing starts and permits way below what had been estimated. They were looking for 1.415 million, and the number came out at 1.239 million. This is one of the lowest numbers that we've had, I guess, since the COVID lockdowns. And the same thing with pending home sales, which plunged, although they revised up last month, so it wasn't quite as bad. It was down 5.4% was the original report for June. And now they revised that to down 4.8. But there was supposed to be a rebound of 1.4 in July. Instead, we had another decline of 2.3%. So overall, between the revision and the worst number in July, it was weaker than expected. In fact, the index, the pending home sale index, which was reported at 72.5 in June, was supposed to go up to 72.9. Instead, it went all the way down to 71.2. So this is another reason why the Treasury is in panic mode with respect to bond market, because the mortgage rates are set off the 10-year U.S. Treasury.
Precious metals led the charge on the buyback news, having already been on a strong run through 2026. Bitcoin joined in afterward, breaking out of a multi-month trading range to top $71,000 to $72,000, its highest level in over 2 months, helped along by a wave of ETF inflows. But the sequencing matters here. Some analysts argue metals moved first and more decisively, with Bitcoin following behind, which skeptics take as a sign that crypto's rally was driven more by momentum chasing than genuine conviction. Others push back on that, pointing out that Bitcoin's correlation with the dollar has grown more complicated in 2026 amid heavier institutional and ETF-driven demand, making it less of a pure risk-off or inflation hedge trade compared to gold.
Now, I don't know why they're not set off the 30-year U.S. Treasury. That would make more sense because these are 30-year bonds. So why are they pricing them off a 10-year Treasury when you got 20 more years of risk? And they have a 30-year Treasury. It's not like they don't have one. So you would think a 30-year mortgage would relate to a 30-year Treasury. And I think even though they're priced off of the 10s, the appetite should be more consistent with the 30, because that's how much risk you're assuming. You're collecting that mortgage for 30 years. I mean, assuming that, it stays. Obviously, a lot of mortgages get repaid early. And that's probably part of the reason, because it's not necessarily 30 years. But believe me, those mortgages that were taken out in the 2s and the 3s, you better believe those things are not going to pay off early. The owners of those, they're going to want to keep them, take them to the grave. They're going to hold them to milk them as much as they can, because the mortgage is what's so valuable, more so than the property. So a lot of banks or a lot of lenders are stuck with this low-yielding 30-year paper. They're hoping that like whoever borrowed that money sells the house or something so they can get out of jail on these mortgages, because they're really liabilities for the lenders. They're not assets. They'd love to get rid of these things. But anyway, so we got that negative economic news. Fed credibility is really going to come into question when it's being undercut by the U.S. Treasury, because this new policy is clearly an easing of conditions, a movement to artificially suppress otherwise rising long-term interest rates, right? Those rising long-term interest rates would have cooled the economy, right? They would have dampened economic activity. But now, because the Fed is trying to artificially suppress them, that is a stimulus. Yet the Fed is supposedly trying to fight inflation with a more restrictive monetary policy. Well, that's just been undercut. And again, as I said earlier, it's going to put tremendous pressure, both behind the scenes and in front of the scenes, on the Fed to cooperate and play ball. Because how is the Fed now going to tighten policy when the Treasury is going in the opposite direction? Right? These guys are working together, Bassett and Warsh. I mean, two Trump picks, right? Trump just picked this Secretary of the Treasury. He just picked this Fed chair, right? They're his buddies. They're on his team. They're all on Team Trump. Right, they're not going to be working at odds with one another. Unfortunately, they're going to be working hand in glove. And so we're going to see much more weakness in the US dollar relative to foreign currencies than what we've already seen today. We're going to see a lot more strength in precious metals. You know, by the way, the yield on the 10-year Japanese government bond yesterday was above 4%. I mean, it's never been above 4% in its history. It's back below now at 3.98, right? It's got a little bit of a reprieve because of the strength of the yen. But, you know, the yen is not that strong. It's not out of the woods. Let me see where the yen is trading right now. I think it's still around 159 to the US dollar, even with the help it got today, 158 and a half. So it's, you know, it's strengthened a little bit, but it's still very close to the danger zone. They're going to press the Bank of Japan, just like they're now going to press the U.S. Treasury on these Treasury buybacks, right? $4 billion, okay, well, can you double it again to $8 billion? They're going to have to do something. And again, the Fed is going to have to come in and do the heavy lifting. Not that they're going to have to. They shouldn't.
The bigger question raised by this week's events, according to several market watchers, is one of coordination between fiscal and monetary policy. A treasury actively working to suppress long-term yields functions as a form of stimulus, effectively working against a Fed still nominally focused on containing inflation, one that held its policy rate at 3.5 to 3.75% in August, with some officials still floating hikes rather than cuts. Whether this reflects genuine alignment between Treasury and Fed leadership or just overlapping responses to separate crises is open to interpretation. Similar pressure is building abroad too. Japan's 10-year government bond yield brushed above 4% for the first time in its history that same week before easing back, a reminder that this isn't a purely American story.